As fears over a recession rise around the world, investors are flocking to the mighty US dollar. The greenback has reached a 24-year high against the Japanese yen. It's also near equal value with the euro, something that hasn't happened in 20 years. Now, fund managers have been buying up dollar-denominated assets, which many view as the best way to protect their money against inflation. Consumer prices in economies big and small have surged this year, due partly to the crisis in Ukraine and its effects on the cost of food and fuel. But even before Russian rockets began falling on Ukrainian cities, goods were already becoming more expensive. That's because of stronger demand following the pandemic and bottlenecks in the global supply chain. Now, for more on this story, let's go to Susannah Streeter. She's an investment analyst at Hargreaves Landsdown in the UK. Welcome back to the program, Susannah. Now, the euro approaching parity with the US dollar steadily. We've seen this over the past few weeks. Why is this so significant?
Well, it is significant because it really does underline the perceived weakness in the Eurozone economy because Europe is considered much more vulnerable given the geopolitical tensions surrounding the outbreak of war in Ukraine. And of course, many European countries are highly reliant on gas imports from Russia. We've already seen this weakness coming through when we hear that actually there could be suggestions that Russia may actually, for example, turn off the major pipeline which is undergoing maintenance from today as a tit-for-tat move for those sanctions that have been imposed. And that makes investors highly nervous. But what you're really seeing is the European Central Bank lagging behind the curve in terms of rate rises because of all of these concerns about the weakness of the Eurozone economy. It doesn't want to put up rates really aggressively because it could tip the European Union economy and those Eurozone countries into recession, whereas, of course, the Federal Reserve is taking a much more aggressive stance towards reining in inflation by hiking rates, and we're expecting a 0.75% hike at the next meeting. So that is why you're seeing the dollar gain more and more strength.
But the U.S. economy has its own problems too, right? So I know rates are going up, so the yields are going to be better, but doesn't that give investors pause? Why does the U.S. dollar remain so appealing?
Well, as you say, as said in your introduction, it is considered to be a real safe haven in terms of heightened insecurity and a heightened uncertainty on financial markets. And that's certainly what you've been seeing. There's a kind of double whammy. At the same time, the Federal Reserve is expected to be much more aggressive in its interest rate policy, but also the dollar is seen as a safe haven. And so there is likely, that's what investors think, that to be kind of less instability and less risks if you invest in US assets, even despite the volatility we've seen on Wall Street in recent months. So that is why you're seeing this kind of double whammy effect.
Right. So we're talking about the euro here, but what about emerging economies? What does a stronger dollar mean for smaller countries in the global south?
Well, unfortunately, it looks like it could compound the problems that many of them are already facing because, of course, they have to buy many of the imports for essential goods and services in dollars. They're priced in dollars, and so it means that those imports will become even more expensive, making the issue of red-hot inflation faced by many emerging economies even worse. So as you see the dollar strengthen, that is compounding the problem. However, looking further ahead, there is an expectation that the Federal Reserve will have to ease off the pedal of rate hikes because the US economy is likely to head towards a downturn and even a recession. And because of that, there is now expectation, and that's been reflected to some extent in the bond markets, that although we're seeing an increase in interest rates right now, in the months to come, looking forward, perhaps a year or so ahead, it looks likely the Federal Reserve will take the pedal off that increase in rate rises and we could even see interest rates drop back, which then would lead to more of a weakness, slight weakness anyway, in the dollar compared to other currencies.